In Washington, the White House has unveiled what it calls the 2026 Affordability Agenda, a major economic effort aimed at easing financial pressure on American households. The initiative introduces new credit regulations, mortgage market interventions, and restrictions on large investors buying single-family homes. Analysts say the package represents one of the most direct attempts in recent years to reshape the cost of borrowing and housing in the United States. President Trump has announced a sweeping set of proposals intended to tackle what officials describe as an affordability crisis affecting millions of families. For years, housing costs, interest rates, and consumer borrowing have remained major economic concerns in the United States. Despite fluctuations in inflation and wage growth, households have continued to face challenges securing affordable mortgages, managing consumer debt, and entering the housing market for the first time. The administration's new agenda is designed to address these pressure points simultaneously. The White House says the plan is aimed at stabilizing financial conditions for families and supporting long-term access to homeownership, two issues that have taken a central role in U.S. political debates. The affordability agenda introduces three core pillars: a temporary credit card interest rate cap, a large-scale mortgage bond purchasing program, new restrictions on institutional investors in the housing market. Officials say these measures are intended to function together, lowering borrowing costs while protecting access to single-family housing stock for ordinary buyers. This is CB News. Subscribe to our channel for daily world news update. Stay tuned. One of the most immediate components of the plan is a one-year cap on credit card interest rates, set at a maximum of 10%. The cap is scheduled to take effect on January 20th and would apply across major U.S. card issuers. In the United States, credit card rates have historically been among the highest forms of consumer borrowing. According to data from financial regulators, average credit card rates in recent years have hovered around record highs, creating financial strain for households who rely on revolving credit for everyday expenses. Administration officials argue that temporarily capping rates will provide relief for families carrying high-interest debt, helping them regain financial stability as broader cost-of-living pressures persist. Consumer groups have reacted to the proposal with cautious optimism. Some see it as a rare and direct intervention in support of household finances, while others warn it may prompt banks to tighten lending standards, making it more difficult for some consumers to access credit during the capped period. Financial analysts say the policy will likely spark debate in Congress and in financial markets. Credit card issuers are expected to challenge aspects of the proposal, potentially pushing for amendments or exemptions. Regardless, the 10% cap signals a major regulatory shift in the consumer credit space. The second pillar of the affordability agenda focuses on the U.S. mortgage market, where soaring interest rates and limited housing supply have pushed homeownership further out of reach for many families. To combat this, the administration has directed the government-backed mortgage agencies Fannie Mae and Freddie Mac to purchase up to $200 billion in mortgage bonds. By increasing liquidity in the mortgage market, officials hope to push interest rates lower, making loans more affordable for prospective homebuyers. Mortgage bond purchases function similarly to central bank interventions. By absorbing large quantities of mortgage-backed securities, the government can influence yields, which in turn affects how lenders price fixed-rate loans. Housing economists say the move could lower borrowing costs, but the scale and timing will determine its overall effectiveness. If implemented aggressively, mortgage rates could decline more quickly, but a slower rollout may produce only modest relief. Real estate analysts also point out that mortgage affordability is only one part of the housing equation. Even if rates decrease, limited housing supply in many regions continues to constrain homeownership opportunities, especially for first-time buyers. The White House says the bond purchase program is part of a broader strategy and that additional actions may follow, including supply-side measures and infrastructure grants aimed at encouraging new home construction. Perhaps the most debated component of the affordability agenda involves housing market access and ownership patterns. Over the past decade, large institutional investors have increasingly purchased single-family homes, converting them into rental properties and reducing inventory for individual buyers. This trend has drawn criticism from housing advocates, economists, and community groups, who argue that investor activity inflates prices, alters neighborhood dynamics, and makes it harder for young families to buy homes. Under the new executive action, the administration will introduce restrictions limiting how and where large investors can purchase single-family properties. Officials say the goal is to protect residential housing stock for owner-occupants and restore balance in the market. The White House has not publicly released the full regulatory framework, but early guidance indicates that qualified institutional buyers may face caps, exclusion zones, or additional taxes on single-family acquisitions in certain regions. Real estate researchers could reshape housing markets in cities where investor activity has been particularly heavy, such as Atlanta, Phoenix, Charlotte, and parts of Texas and Florida. Investor groups and real estate firms have raised concerns, warning that restrictions could disrupt rental markets and reduce housing availability for tenants. Tenant advocates counter that homeownership remains a central pathway to financial stability and that owner-occupied homes benefit communities through stability, engagement, and long-term investment. The affordability agenda arrives at a time when economic sentiment remains mixed. While inflation has cooled from its peak and unemployment remains relatively low, cost of living concerns continue to rank among the top issues for American households. Housing costs in particular have outpaced wage growth in many regions, contributing to a growing sense of financial insecurity. First-time buyers have faced unprecedented hurdles, while rental markets in major metropolitan areas remain elevated. Economists note that the administration's plan differs from previous economic strategies in its focus on credit costs and investor behavior. Rather than centering on traditional stimulus or tax cuts, the agenda targets structural issues in financial markets that directly influence everyday expenses. Politically, the package sets the stage for debates heading into a midterm year. Democrats, Republicans, housing advocates, and financial industry groups are likely to contest aspects of the proposal, shaping how and when components are implemented. International observers are also watching closely, as the United States plays an outsized role in global financial markets. Mortgage-backed securities, U.S. interest rates, and credit conditions all influence international capital flows, meaning policy changes may ripple across foreign markets. Early reactions from economists and analysts have been mixed, but largely focused on feasibility and impact. Some applaud the White House for acknowledging affordability challenges and acting decisively, noting that mortgage and credit conditions have been major contributors to household stress. Others question whether the measures can overcome broader structural challenges, including housing shortages, zoning barriers, labor shortages in construction, and uneven wage growth. Financial markets are also assessing potential consequences. A mortgage bond purchase program of this size could influence yields, investor demand, and pricing in related credit products. However, the temporary nature of the credit card rate cap means banks may wait for regulatory clarity before adjusting lending practices. The investor restriction component may take longer to evaluate, as regulatory frameworks need to be drafted, tested, and enforced. Local housing conditions vary widely across the United States, and analysts say targeted enforcement will be essential to avoiding unintended consequences. For families navigating today's financial landscape, the affordability agenda presents both potential relief and uncertainty. Households carrying credit card debt may benefit quickly from capped rates, reducing interest burdens and allowing savings to grow. Prospective homebuyers may find improved mortgage conditions in the coming months if bond purchases exert downward pressure on interest rates. And first-time buyers may face less competition from institutional investors if restrictions effectively rebalance market demand. However, experts caution that no single policy can resolve the full scope of affordability challenges. Housing supply remains limited, inflation remains a factor in household budgeting, and consumer debt levels continue to rise. The White House argues that the affordability agenda is a starting point, a foundation for additional reforms that could emerge in the months ahead. Officials have signaled that more proposals are in development, focusing on construction incentives, student loan reforms, and cost of living initiatives. The 2026 Affordability Agenda marks one of the administration's most comprehensive economic efforts to date, targeting core cost drivers for American households. By capping credit card rates, intervening in mortgage markets, and restricting large investor activity in single-family housing, the White House aims to provide relief and restore balance during a period of heightened financial strain. As policy debates unfold and market reactions take shape, the coming months will determine how quickly these measures translate into meaningful changes for families across the United States. For now, analysts say the package reflects a growing recognition that affordability has become a defining economic issue and one that will continue to shape political, financial, and social priorities well into the future. CB News, bringing you World News Update. Thank you for watching.